Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Ptc Inc. quarterly report. Ptc Inc. offers a wide range of software solutions to various industries. At the core of its offerings are several key products that enable companies to manage their product development lifecycle, PLM, more efficiently. These include Windchill, ThingWorx, ServiceMax, Arena, and FlexBLM. These platforms provide real-time information sharing, collaboration tools, and data visualization capabilities that help manufacturers elevate their product development, manufacturing, field service, and end-of-life processes. In addition to these PLM solutions, Ptc Inc. also offers a range of other software products and services. These include application lifecycle management, ALM solutions such as Codebeamer, service parts management with Servigistics, and industrial connectivity solutions like Kepware and KepServer X. The company also provides 3D CAD technology through Creo and Onshape, which is a SaaS product development platform that delivers computer-aided design with data management, collaboration tools, and real-time analytics. Ptc Inc.'s offerings also extend to augmented reality (AR) software with Vuforia, dynamic publishing solutions like ArborText, and technical documentation management. Furthermore, the company provides PTC products, PTC MathCAD, and other augmented reality products that cater to various industries and needs. With a presence in the Americas, Europe, and the Asia-Pacific, Ptc Inc. has established itself as a leading software company with a diverse range of solutions for product development, manufacturing, and service management. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what might cause a stock price to drop. The stock price of any company can fluctuate due to various reasons. One major factor is the overall performance of the company itself. If a company's sales and profits decline, its stock price may also decrease. Additionally, changes in industry trends or market conditions can affect a company's stock price. For instance, if a particular sector is experiencing a downturn, companies within that sector may see their stock prices drop. Another reason for a stock price to drop is external factors such as economic recession, global events, or regulatory changes. These factors can impact consumer spending habits and business operations, leading to decreased demand and revenue for companies. Furthermore, if a company faces financial difficulties, such as high debt levels or declining cash flow, its stock price may also decline. In some cases, a stock price drop can be attributed to internal issues within the company itself. This could include poor management decisions, lack of innovation, or failure to adapt to changing market conditions. In such situations, investors may lose confidence in the company's ability to perform well, leading to a decrease in its stock price. In conclusion, there are various reasons why a stock price might drop. It is essential for investors and analysts to carefully examine these factors when assessing the performance of any company. Ptc Inc. market capitalization of $19 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Ptc Inc. holds a significant advantage in their industry. Ptc Inc. trades at a lower price-to-earnings ratio of 23 times and a higher price-to-book ratio of 4.82 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 42% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of various financial metrics. On the growth side, license revenue saw a significant increase of 56.5%, while support and cloud services revenue grew by 9.3%. The recurring revenue also experienced a substantial boost of $132.97 million, representing a 25.1% growth. Furthermore, the product lifecycle management (PLM) segment grew by $78.08 million, with a notable increase in the Americas region by $42.96 million and Europe region by $75.5 million. In contrast, professional services revenue declined by 26.8%, while perpetual license revenue saw a decline of $3.775 million, representing a 40.8% decrease. The computer-aided design (CAD) segment also experienced a decline of $42.615 million, with a significant drop in professional services revenue due to the company's decision to leverage partners for service delivery rather than contracting directly. Overall, the data suggests that license revenue and support and cloud services revenue are key drivers of growth, while professional services revenue is a major contributor to decline. The net income of the company experienced a significant increase from 2024 to 2025, rising by 102% to reach $166,518,000. This growth was also evident in the first quarter of 2026, where it increased by 118% compared to the same period in 2025. The profit margins of the company also saw a substantial improvement, with gross margin increasing by 25%, operating income rising by 91%, and net income margin expanding from 2.1% to 3.4%. The reasons behind these changes are multifaceted. One key factor was the growth in license revenue, which led to an increase in license gross margins. Additionally, support and cloud services also saw a rise in revenue, resulting in higher gross margins for these segments. The company's compensation expense decreased by $6 million, contributing to its improved net income. Furthermore, lower debt balances resulted in reduced interest expenses, while a net income tax benefit of $7.1 million was realized due to IRS procedural guidance. The operating margin also saw a notable increase from 20.4% in 2024 to 32.2% in 2025, indicating that the company's operational efficiency improved significantly. The non-GAAP operating margin rose even further, reaching 45.1% in 2025, demonstrating the company's ability to generate profits without accounting for certain one-time expenses. Overall, these changes suggest a strong financial performance by the company, driven by various factors including revenue growth, cost reduction, and improved operational efficiency. The company's financial performance indicates a healthy trend. One key indicator of this is the generation of positive operating cash flow. In both 2024 and 2025, the net cash provided by operating activities was substantial, with $238,429 in 2024 and $269,745 in 2025. This consistent positive cash flow suggests that the company's operations are generating sufficient funds to cover its expenses and invest in growth initiatives. The company's financial health has been stable over the past year. A review of the extracted summaries reveals that there has been no significant change in the company's debt level. The total debt remained constant at $1,200 million as of December 31, 2025 and September 30, 2025, with only a minor fluctuation from $1,197,700,000 to $1,197,400,000 between 2024 and 2025. Furthermore, the interest expenses have also decreased significantly. The interest expense on debt decreased by $4.7 million from 2024 to 2025, representing a 22% decrease. This reduction is attributed to lower debt balances, which has resulted in lower interest payments for the company. Overall, these findings indicate that there has been no significant change in the company's debt level or interest expenses over the past year. The company's performance across various segments and regions has been mixed. On the positive side, product groups such as PLM and CAD have shown significant growth, with increases of 22% and 20%, respectively. Similarly, geographic regions like the Americas and Europe have performed well, with growth rates of 15% and 39%. However, the Asia-Pacific region has struggled, experiencing a decline of 2%. These results indicate that while certain areas of the business are thriving, others require attention to improve performance. Management is optimistic about the company's future prospects, citing plans for continued growth through investments in software solutions, including AI capabilities. The company has a sufficient cash reserve to meet its working capital and capital expenditure needs for at least the next 12 months. Additionally, management intends to use excess cash from the recent divestiture of Kepware and ThingWorx to repurchase shares, aligning with its long-term goal of returning value to shareholders. Furthermore, the company expects its annual recurring revenue, ARR, to increase over time as more customers commit to longer-term contracts, contributing to sustained growth. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the company has recorded goodwill of $3,412,586 as of December 31, 2025, and acquired intangible assets worth $804,203 during the same period. The Kepware business and ThingWorx business were also acquired by the company. In addition to these acquisitions, the company has made several divestitures. Assets held for sale totaled $145,204 as of December 31, 2025, indicating that the company is in the process of selling off certain assets. The Kepware and ThingWorx businesses were also divested by the company, suggesting a strategic shift in its business operations. The acquisitions and divestitures made by the company reflect its efforts to expand its capabilities and streamline its operations. By acquiring new businesses and selling off underperforming assets, the company is positioning itself for future growth and success. The company's recent financial activities have been marked by a significant focus on share buybacks. In the past 2 years, the company has made substantial investments to purchase its own shares from the market. Specifically, in December 2025, the company bought back 1.1 million shares for $200 million, while in December 2024, it acquired 0.4 million shares for $75 million. These transactions demonstrate a clear strategy of reducing the company's outstanding share count and potentially boosting shareholder value through increased earnings per share. That concludes the financial summary for Ptc Inc. Feel free to comment below, and I will be happy to answer them when possible.